sandbox for regulators, and I'm hopeful for leadership from the White House Office of American Innovation as well. I believe DARPA and the Department of Defense have flexibility when it comes to exploring innovative technology. Our markets are vital to our prosperity and security as well, and I believe that this will benefit the taxpayer as well as the investors in our markets we'll talk about today. I will conclude with a few observations about recent SEC actions in the context of the initial coin offerings, also known as ICOs or token sales. This is quite a new phenomenon, as Commissioner Stein alluded to. And to put it in context, I see it as the third in a series of enormous interconnected innovations in a few short years. First, the rise of Bitcoin and these cryptocurrencies. Second, blockchain distributed ledger technology, and now the ICOs. These are all interrelated. These have huge implications for investment and capital formation, for democratizing access of retail investors to new and innovative businesses, and opportunities to incentivize and monetize ideas at an early stage of development through funding of so-called utility tokens. In 2017, to date, there have been over 250 of these ICOs, raising over $2.25 billion. There is also clearly potential for huge losses due to fraud and cybercrime, two sides of these coins. I believe the SEC is taking very effective measures to balance its responsibilities to protect investors while allowing new technologies to develop. The SEC's July report of investigation about the issuance of the so-called DAO tokens in 2016 provided a crystal clear analysis of the issuance of these tokens and their status as securities. It made clear that the Howey test. By that I mean it was a true landmark in its sphere in clarifying the SEC's jurisdiction in this space, just as that early US Supreme Court case was a landmark in establishing the court's jurisdictional power of judicial review. And like Marbury versus Madison, it neatly established the principle, providing clear analysis in the particular case. The SEC's report put the market on notice that these tokens can be securities, but did so without a blanket or extreme approach that some jurisdictions have applied. Blanket or extreme approach that some jurisdictions have applied in banning all ICOs. The SEC has taken a balanced approach, providing a clear line of demarcation while recognizing that one size does not fit all. A one-size-fits-all approach would stifle innovation. The July report was extremely received by the market, in my view, as setting forth a clear dividing line and providing greater legal certainty. The SEC has since taken further steps with the creation of the Cyber Task Force, the announcement of its first enforcement actions against ICO fraudsters, and recent investor warnings. I believe the markets are welcoming and adapting to greater legal certainty, accompanied by robust enforcement. I thank you again for inviting me here to address this distinguished forum, and I would be happy to answer any questions. Thank you.
Thanks, Jeff. So Marbury versus Madison, you can tell the chair in terms of very impressive. Michael, welcome. Thank you for being here.
My apologies for being late. Traffic in Washington is interesting, to say the least. But good morning. Thank you for inviting me today and providing the opportunity to discuss distributed ledger technology and its impact on market infrastructure. As you know, DTCC has a unique position in the marketplace. We are a user-owned and governed market utility for the global financial services, and we act as the central counterparty for the cash markets here in the United States. Our systemically important financial market utilities, DTC, FICC, and NSCC, processed security transactions last year valued at approximately $1.5 trillion. We've flipped the GDP every 3 days. I'll give a prize here, whoever knows how many zeros are a quadrillion. We have a 40-year history of leveraging technology to drive innovation and reduce risk and cost for our clients. If you think back to the start of DTC, it probably was viewed as heresy to say, let's centralize all processing of securities and put it on a computer, rather than the old days of having every drunk south of Soho running around delivering certificates versus checks on a bilateral basis. It's somewhat ironic that we're talking now about moving away from that central process and going to a distributed bilateral method of settlement. Today, we are building on that legacy by actively exploring and advancing the use of FinTech to enhance post-trade processing, while ensuring future applications are consistent with our shared goals of risk mitigation, market safety, certainty, reliability, and efficiency. Like many of our peers in the industry, we're very excited by the many new innovations that have emerged in the past several years, such as distributed ledgers, robotics, machine learning, and AI, as well as cloud computing. We have been actively experimenting with DLT because we believe it represents a significant opportunity to reimagine post-trade infrastructure, but by working in collaboration with the industry and by aligning the technology with our core mission of increasing efficiency and reducing risk. Services in the media because of its potential to modernize the post-trade environment in areas like clearance, settlement, and payments. While DLT is beginning to move beyond the hype of a couple of years ago, the technology still needs to be proven before it can be widely adopted or considered enterprise-ready. We've made significant advancements with internal experiments and have further developed our technical abilities with the technology as we advance initiatives related to derivatives and securities post-trade processing. For example, let me tell you about our work to re-platform our trade information warehouse. The trade information warehouse was created back in 2006, and is a database of credit default swaps and acts as the mechanism for netting payments and dealing with credit events when they occur, built on the mainframe. We selected IBM in partnership with Axoni and R3 to provide a DLT framework to drive future improvements in derivatives post-trade lifecycle events. The firms are working collaboratively, building a derivatives distributed ledger solution for post-trade processing based on existing trade information warehouse capabilities and interfaces with technology providers and market participants. So while we've been exploring DLT for more than 2 years now, in the trade information warehouse project alone, we're gaining real-life experience of development, testing, and experimentation of replacing an industry-wide critical mainframe application. We've learned what works, and we've seen the technology's limitations that have yet to be overcome. Across all of our DLT work the past couple of years, it's clear that the technology is still evolving. I think people need to remember we're still in 1.5, 1.6. This is not version 5, version 6 of the technologies. Critical factors for DLT moving forward include maturing the platform's capabilities for real-world financial transactions requirements, scalability, interoperability, most importantly, possibly, governance. I want to spend a few minutes on the issue of scalability because it represents one of the most significant limitations many of us are working with the technology I've encountered so far. DTC operates some of the industry's most robust processing engines. We handle more than 100 million transactions per day, and our peak processing hits 25,000 transactions per second. Enterprise rate, thank you. No, we never miss. We never miss. And just the irony is to put it back into context. We run COBOL, 55 million lines of COBOL on the mainframe. We've been called Neanderthals by many people. It's been there for 40 years. It's never missed a day. It's reliable. It's resilient. And we're taking the big leap of saying we're going to get rid of it because there's no longer a lot of COBOL programmers under the age of 65, unfortunately. So, any enterprise-ready distributed ledger that we employ must be able to handle the transaction processing performance of real-world financial systems, including validation and irreversible transaction finality, and have the flexibility to manage increased volumes and support the throughput needed. A critical component of our DLT platform evaluation includes pressure testing high transaction processing volumes and benchmarking against production results to make sure they meet or exceed current standards. There's a lot of talk out there. You'll see people saying, well, we can do 100,000 transactions a second. That's point to point, very simple. I move something from A to B on a blockchain. You have to validate, you have to enrich it. All the add-ons that we do in those 25,000 transactions we do today, that's the real test. It's not simply saying, I can use a blockchain to go from A to B. There's an important benefit of our early effort in the trade information warehouse. Because of the scale of the warehouse is a fraction of DTCC's daily securities processing, there are fewer hurdles to overcome before you can see a real potential for DLT benefits. Another key consideration of DLT's benefits to securities processing will come from all the myriad aspects of the processing, starting from initial registration through trading through corporate actions. One early starter in DLT for securities processing came in and said, I can issue a security and I'm going to settle it. I'll show you that I can do that. Then I said, can you do a short sale? And they said, I'll get back to you. They haven't figured out securities lending. We had another individual come in and say, gross settlement is the best way to go. Right now, what we do, we take those 100 million transactions and we net them down to 3 million net trades at the end of the day, and they settle now on a T2 basis. What if those 100 million trades now are done on a gross basis throughout the day? Cash management would become an absolute nightmare because you would not know when your buy settle, when your sell settle, et cetera, et cetera. And all that movement would create operational risk and massive cost. The banks would love it. The overdraft, daylight overdrafts would go through the roof, so the Fed would hate it. And we would love it because we'll take a piece of transaction along the way. But those are some of the issues that you have to kind of encounter along the way. Smart contracts may provide some answer for some of the standard items of information beyond a simple ledger of ownership. But different technologies today are using different programming languages for their contract development without any common standards or guidelines. As this is the early stage of smart contract development, it's important to consider how and if our clients are preparing themselves to consume and support various programming languages. You need to have a standard template. Smart contracts sound great, but you need to have a template for what does a corporate bond look like, and if you're issuing it on different platforms and different languages, how are you going to interoperate on those? With so many firms exploring and advancing use cases with a variety of technology providers, DLT platforms, and software solutions, the industry needs to do a better job of determining how multiple ledgers will integrate, not only with other ledgers, but also related to legacy infrastructure. We just successfully migrated from T3 to T2 in this industry. It took us 5 years, right? DTCC launched the study 5 years ago. It took 2.5 years to convince the industry to go to T2. Now, did an amazing job of testing, preparation, and T2 went absolutely flawlessly. There were no major system changes that had to happen because of T2. You know, there were some, but there were no major system changes that had to happen in T2. If I turned around, walked up to the industry and said, by the way, I'm scrapping all my systems, I'm going to distribute a ledger, and in 5 years, all of you now have to connect through a node, scrap all your existing systems, and rebuild all your systems to take the advantage of DLT. You'd have hundreds of millions, if not billions of dollars of systems write-offs and rebuilds that have to get done. So while we're very optimistic about DLT, one has to also frame it and say, this is a journey. This is not going to be something that happens in a very short period of time. DTCC has been a very vocal proponent for greater collaboration across the industry in pursuit of the long-term goal of establishing standards and achieving interoperability across ledgers. We're strong advocates for open source, and we serve on the governing board at the Linux Foundation's Hyperledger project. We're one of the 30 founding members, and also hold a leadership role with the Enterprise Ethereum Alliance to advance this objective. Addressing the issues of interoperability and the needs for consistent standards remains a top priority, along with developing the appropriate governance to operate the permissioning into the network and allowing nodes onto the network. I think Nancy mentioned this. How do you protect yourself against who is going to have access to the system? In addition, we need strong governance to verify the code of smart contracts and control the kill switch to stop the potentially disastrous results of an error in the code. Think back to 2008. There were more than one time where either regulators or ourselves stepped in to stop the Thelma and Louise happening as the market looked like it was going to crater over the cliff. You need to have that capability. Governance cannot be outsourced to every individual chain creator or FinTech developer. If that were to happen, interoperability would be difficult, costly, and probably non-existent. In fact, the industry has encouraged DTCC to take a leadership role on these issues. Because, as an industry-owned and governed utility responsible for protecting the stability and integrity of the financial system, governance is in our wheelhouse. Of course, I can't speak in front of a regulatory audience without stressing the importance of collaboration between the supervisory community and the industry. One of the most important pieces of work that still needs to be done is to understand how technology fits into an existing regulatory framework. As a real-life example, this is early days, I tasked my risk people to start thinking about what if you had distributed ledger using AI at the same time so that we would anticipate positions coming into the marketplace and through AI adapt to what's happening in the market and what is going to happen in the marketplace on a real-time basis. So our margin models will be self-correcting. It sounds great, except I'm going to run afoul of margin rules, which would say that every time I change my models, I have to report it and get permission from the SEC. So how do we work with the regulators to create this construct where we're actually improving the safety and resiliency of the marketplaces, but doing it on a real-time basis. Probably 15 years ahead of us, but it's in the future. It will be happening. It goes without saying that we expect the current regulatory framework, which has been created over the past 70 years, will need to evolve as DLT and other FinTech solutions are implemented. We're encouraged by the potential of DLT to provide regulators with enhanced oversight of the markets and deeper understanding of financial risks, as Jeff pointed out. Rules facilitating and supporting technological advancements while not overtaking the ongoing important policy objectives, such as risk mitigation, investor protection, resiliency, market and regulatory transparency, will be an important feature of the evolution. The industry understands that this is challenging work, which is why it's important that we have an ongoing engagement and dialogue with policymakers, supervisors, and other key stakeholders. We applaud the approach of the SEC and many other regulators who have taken the time to engage, learn, remain flexible, and seek a deeper understanding how DLT can fit within the existing set of rules and regulatory goals. I look forward to exploring all these issues and many more with the panel and all of you today. Thank you again for inviting us.
Thanks. Actually, Fredrik, I'm going to have you go next, and then Adam will be our final speaker, so you can talk a little bit about what Nasdaq is doing, and I think it sort of builds on Michael's experience at DTCC.
Certainly. Madam Commissioner, Madam Chairman, members of the committee, thank you for the invitation to Nasdaq and myself to address you here today. I'd like to share our approach to some of the innovation possibilities brought to capital markets by blockchain technology. Our blockchain initiative is about 4 years old. We started in 2013, so we were very early out. My participation has been over the last 2.5 years. My background is really in commodity derivatives, so I'm more akin to Jeff's old hunting grounds than the SEC, but here we go. So I'm delighted to be here. I'll provide some examples of potential uses of the technology in capital markets, some of the challenges to wide-scale adoption, and also what we are specifically doing with the technology and what with sort of projects that we have announced that we're working on. But allow me to start putting our initiative into a wider context. I guess I may be wrong, but I guess most of the people in this room think of Nasdaq as a stock exchange based in New York. That is of course true. In fact, we run about 10 different stock exchanges across North America and in Europe. In addition, we operate even more derivatives exchanges across almost all asset classes. We run derivatives exchanges for indices, for equities, for fixed income, for commodities. In Europe, we also operate central security depositories and clearinghouses. However, through our market technology unit, Nasdaq is also a leading global provider of technology for trading, clearing, exchange operations, market surveillance, listings technology, market information, and public company services. In fact, Nasdaq technology powers over 90 marketplaces in 50 countries over the world. 1 in 10 of the world's securities transactions are in some way or form processed through Nasdaq technology. And as a user ourselves and a provider of critical technology to capital markets around the world, we owe it to ourselves, to our clients, our shareholders and other stakeholders, for example, regulators, to understand the opportunities and potential risks arising from new technology. Hence, in addition to our blockchain track, we have ongoing programs for machine intelligence, Internet of Things, virtual reality, quantum computing, the use of cloud computing in capital markets, etc. Anything that could have potential impact on capital markets goes through our washing machine. And the common themes across these innovation tracks are the never-ending quest for increased efficiencies and productivity, but also the possible identification of new business models and alternative market structures. With that background out of the way, please allow me to share some more details on our approach to the blockchain space. First of all, like most of us in the room, we believe that blockchain or distributed ledger technologies could have profound implications for securities markets. A technology that allows market participants to keep track of possession of any digitized asset in a peer-to-peer market structure can radically transform the processes and activities that were previously organized around dependence on a trusted third party. Now, when we talk about the digitized asset, we mean anything. It can be a security, it can be money, it can be a piece of code, it can be a song, it can be any digitized asset. But of course, here we're talking about capital assets. But also, the immutability and traceability of transactions recorded on a blockchain brings new possibility that previously haven't existed. Our work in the blockchain space is currently focused on the use of the technology in traditional financial markets. We of course follow the evolution of the crypto asset space, for example, the booming ICO market, but our activities are mainly focused on the following three areas. We picked these three areas because they make sense for us. It's a good place to start. They make most sense for us. It doesn't mean that we think that other areas are not relevant, but we have to start somewhere. Firstly, we explore the post-trade plumbing of securities markets. We don't believe the features of blockchain technology are superior to traditional technologies when it comes to facilitating high volume, low latency price discovery processes, exchange, but we do believe that the fundamental uses of the technology, as in fact proven by the crypto asset space, can be translated and transferred and enhanced and be used in traditional capital markets over time. Secondly, a lot of the work we do focus on the relationship between the issuer of an asset and the investor of said asset. The ability for a community of issuers and investors to interact on a joint coherent network where contact is just a network address away is a powerful promise. And of course, the relevance of this promise depends upon what kind of market structure you are in. You know, there are markets around the world where you have very close, efficient contact between investors and the issuers. There are other markets where that requires a large number of intermediaries and costly steps to establish that contact. Finally, as also pointed out by previous speakers, the possibility for enhancing society's awareness of what is happening in capital markets is very appealing. In a scenario where digitized assets are circulating in a common shared network, it should be possible to provide regulators with tools allowing them, for example, to see where concentration and systemic risks are forming on a real-time basis. In addition, identification of suspicious transactions should be more of a real-time affair than today's efforts of trying to puzzle together dispersed pieces of fragmented data across unsynchronized databases. Most of the implementation projects we undertake fit into one or several of these categories above. Nasdaq has so far announced about, I think it's 6 or 7, publicized implementations that leverage blockchain technology. We work on a number of other projects as well, of course, but these are the ones that we have publicized. Each provide an example of how blockchain technology could potentially have implications for securities markets, and please let me highlight 3 of these. First, what is commonly known as the Link project. We built an application leveraging chains. We'll hear more about chain from Adam, of course, but leveraging chain core blockchain protocol that allows private companies to record shares in blockchain format, transfer those shares to its investors, and permit investors to transfer shares between each other electronically, peer-to-peer, without the need for a central party. Nasdaq's and Chain's role in this solution is purely as technology provider. The legal relationships are bilateral. Secondly, we have developed a voting application that leverages the immutability and traceability of blockchain technology. The application allows companies to digitize votes that reflect share ownership and submit those voting tokens to investors on a blockchain network. The application then allows the investors to remotely, being present in the room, but remotely cast the votes or delegate votes to other parties on the network. The investors can follow the whereabouts of the voting token, as we call it, on the network, ultimately being able to identify in which ballot the vote was cast. This not only benefits the investor, but also the intermediaries, as they can now undisputedly prove they voted in accordance with the instructions of the investor. So think of these votes as little tokens that sort of fly around a network, and the people who should see where it is can always see where it is. But you can send it to an intermediary, you can call it back, you can send it to someone else, and ultimately it is voted for in the relevant ballot. My third example maybe is not directly towards sort of securities markets, but it shows what can be done when combining new technologies. Again, using chains, core protocol, and an Internet of Things device, we built a prototype that connects a solar panel with a blockchain. As the sun shines on the solar panel, it automatically and in real time generates renewable energy certificates onto the solar panel's blockchain address. Leveraging so-called smart contract capabilities, the solar panel then can submit sell orders to a marketplace and self-settle any transactions on the blockchain when the price of the renewable certificate reaches a desired price. In addition, we are working on projects for transaction recording, position keeping, and settlement of transactions for anything from advertising forward contracts to mutual funds to structured products. Finally, and slightly different from the above, the Nasdaq Stockholm, appropriately named Nasdaq Stockholm Stock Exchange in Sweden, lists 4 exchange-traded notes for public trading that track the prices of Bitcoin and Ether. While fundamentally being optimistic about blockchain technology's potential in capital markets, we also do recognize that the road to wide-scale adoption of blockchain solutions may not be short and straight. A number of factors beyond the evolution of the blockchain technology itself, as highlighted in Mike, for example, will impact the pace of adoption. This is not an exhaustive list, but here are examples of a few such factors. While the vision brought by the new technology of faster, cheaper, more secure capital markets gains increasing acceptance, one must understand that going from a vision to agreed blueprints and detailed design on new solution and market structures is very, very difficult. And it may not be a showstopper. We reform the markets all the time, DTCC going from 3 to 2 days and innovations of all kinds, but it has an impact on the time to adoption of the technology on a wide scale in large capital markets. Secondly, we do not subscribe to fears voiced by some participants that regulators and regulations prohibit innovation based on blockchain. What seems more relevant to us is the fact that many of the innovative market structures and business models that are potentially enabled by this new technology were simply not contemplated when existing laws and regulations were written. And of course, this varies from jurisdiction to jurisdiction and country to country, but this situation potentially creates legal voids, and few traditional market participants are going to allocate billions worth of assets to structures where there is uncertainty, or for example, the legal status of transactions recorded on a blockchain. Again, this is not a showstopper. Laws and regulations change all the time and adapt to technical innovation, but it does have an impact on the adoption timeline. Thirdly, the new technology is not implemented in an empty world. It must be integrated in an already complex ecosystem of pre-existing technical infrastructure. Again, technical integration is something that happens frequently in capital markets all the time. Effectively, we implement a technology and integrate a system in capital markets around the world weekly. So it's not a showstopper, but it also has an impact on the timeline. And these things have to come together at the same point in time for this to be adopted on a wide scale in capital markets. And of course, it competes with attention from other matters. You know, proposing a wholesale restructuring of settlement of securities in Europe is impossible, as everyone is focusing on MiFID II. So, and this happens all the time. So, but trying to sum up the above discussion, I'd like to say that Nasdaq strongly believes that blockchain-based solution can have significant impact in securities markets. The route to get there, in our opinion, will be through successful implementations of projects that demonstrate the value of new market structures and business models enabled by the technology. Such projects are now being implemented in many parts of the world by, for example, Nasdaq, Chain, DTCC. If these initial projects prove successful, we believe that the appetite for the technology in capital markets will grow rapidly, and at that point we might see an inflection point where people, you know, we've gone from awareness to interest to desire to really markets want to take action and improve on how they run. But if they have less success in these early implementations, we think that blockchain-based solutions will still play a role in capital markets, but the use will probably be much more selective. So thank you for your attention. I'd be happy to ask any follow-up questions.
Thank you. Thanks. Adam, you get to be our wrap-up speaker and pull this all together for us.
Thank you so much, Madam Commissioner, Madam Chairman. Honored to be here today. It's somewhat intimidating to go last after such esteemed speakers and comments. I've already covered so many of the relevant points, but I'll attempt to summarize and maybe leave everyone with a framework for thinking about these new technologies. So my name again, Adam Ludwin. I'm the co-founder and CEO of Chain. Chain is a startup. We're a technology company, and we are one of the companies building the underlying technology, the cryptographic ledgers that are powering these new financial products that you're hearing about. We're based in San Francisco. We've raised about $40 million in venture financing, and we're most known for our work, of course, with Nasdaq that Fredrik highlighted, but also our work with Visa and Citigroup. So, there's a lot of noise out there. That's my main message today. There's a lot of noise, and there is very little signal in that noise. But there is some. And so what I want to achieve in my remarks is giving you the ability to sift through the noise, identify the signal, and be more effective with your very limited time. To start, virtually every financial institution that comes into the doors of Chain opens by saying that they want to do something with blockchain. And most financial institutions have some program in place to explore blockchain. And on the investor side, almost all investors now say that they want some exposure to cryptocurrencies, or they want to think about investing in cryptocurrencies because of their meteoric rise, especially over the last 6 to 7 months, going up in many cases by 50 or 100 times, which is unlike the growth and return of any asset class in modern experience. So the question is, where is the signal? And is this stuff real, or is it fleeting? And I think first and foremost, we have to appreciate that there are actually two very distinct markets and segments that have been somewhat conflated in the press. And it's helpful to separate them and to always ask yourself, which of the two segments are we talking about? The first segment are cryptocurrencies, and the second segment is what generally we've been referring up here as blockchain, but I really think it's helpful just to think of it as a cryptographic ledger. So on the one hand, you have a new asset class, and on the other hand, you have simply a new tool for financial institutions. And it would be, I think, helpful to provide an attempt at a working definition of each of these two segments. And with that definition, we can better understand what they are. So let's start with cryptocurrencies. What the heck is a cryptocurrency? Here's my definition. A cryptocurrency is a new asset class. Don't get tripped up by the word currency. It doesn't fit cleanly into the asset class known as currencies. It's actually, I think, more helpful to think of them as crypto assets. And like every other asset class, it's in service to something else. So if you think about, let's go through some other asset classes. Think about securities, company securities, shares. Those shares are in service of the corporate form of organization, companies, right? You think about bonds. Those bonds are in service of either governments or companies that are raising capital, or real estate assets, obviously in service of physical structures, and on and on and on. So whenever you think of an asset class, what is the higher order thing that it's making possible, that it's funding? It turns out that crypto assets, cryptocurrencies, are no different in terms of the mental model. They are also in service of something else. They don't exist for their own sake, despite it sort of feeling like that at times. And so what are they in service of? Cryptocurrencies are in service of enabling a new form of software, a new model for writing and creating software. And that new model I would call decentralized software or decentralized applications. Okay, so what is a decentralized application? Simply stated, it's a version of a service that we already have today, but where there's no central entity providing that service. So the first well-known example of a decentralized application was a decentralized payment service, a way to pay people without those payments running through a centralized entity like a Visa or a PayPal. Does anyone know what it's called? Bitcoin. Yes, Bitcoin. So let's think about how do we make a decentralized application possible? Well, we need, if we're going to not have a central entity with a corporate form of organization with a profit motive in a market-based system, we need to find a new economic model, some new economic incentive to incent entities to contribute resources of some kind to making that service possible. And that's exactly what Bitcoin is and is for. Bitcoin, you think of as the thing that people pay each other for goods and services. Actually, that's sort of almost the secondary market for Bitcoin. The primary market and its primary function as an asset is to reward the computers and the entities that are processing transactions on the network. Those entities in Bitcoin are known as miners, and they take those Bitcoins that are rewarded to them by the network and they sell them on exchanges, and that's how they get into circulation and become usable as a payment instrument. So Bitcoin was the first well-known decentralized application. Again, a service we already have today, but without an entity running it, any centralized entity. And over the last few years, we've seen other decentralized applications emerge. Let me give you two other examples. One recently this year was called Filecoin. So Filecoin is a great name because it's exactly what it sounds like it does. It's a decentralized application for storing files, photos, music, etc., without a central file storage system like Dropbox, or on the enterprise side, Amazon S3, these centralized cloud file storage systems. Instead, files can be shared and distributed over a network of computers, and you guessed it, those computers, those folks storing the files and processing the transactions, movement of those files, are rewarded for doing so, for incurring the real cost that it requires to do that with Filecoins. And just like with Bitcoin, those Filecoins go into circulation and people can speculate on them. But unlike Bitcoin, you wouldn't necessarily send Filecoin for the remittance of goods and services. It really is just in service of the underlying file storage application. Another example, and an important and extremely confusing one, is Ethereum. Ethereum is confusing because it's meta, which means it's a decentralized application for launching decentralized applications. And many of the so-called initial coin offerings, token sales, new tokens, are built on top of Ethereum because Ethereum makes it very easy to create a whole new decentralized application. Filecoin is written from scratch. It's a whole independent stack. Ethereum lets smaller teams with less resources and time create these tokens very easily. So this is actually it's worth pausing and just observing that this is pretty miraculous, that we now have a technology paradigm where we can offer services in the world without the corporate form of organization. It's really a protocol form of organization. And just as the corporate form is supported by securities, these protocol forms are supported by crypto assets or cryptocurrencies. However, and there is a big however, you cannot argue that for everyone, Bitcoin is better than Visa, or Filecoin is better than Dropbox, or Ethereum as a computing platform is better than cloud computing. In fact, on virtually every dimension, whether it's speed, scalability, cost, user experience, user ability to secure their assets, drama-free operation of these services, on virtually every dimension, the centralized versions beat the pants off the decentralized ones. So where's the excitement? Like, why do we care? Especially because, as you've noticed in these examples, none of them are actually providing anything net new in terms of new functionality. They're just changing the way things are done. We've already had payments, we've already had file storage, we've already had computing. So like, where's the excitement and enthusiasm coming from? And the answer is that there's one dimension where decentralized applications are not only better than centralized, but achieve something impossible to achieve on centralized services. And that is censorship resistance. Censorship resistance means that these decentralized apps are open and they provide unfettered access to anyone or any entity who wants to use them. In other words, no one can stop me from sending Ms. Stein a Bitcoin. No one. And yes, there are choke points on these networks where centralized services pop up to provide services like exchanges, etc. But if at the end of the day, this is a network where I can simply open up a laptop, connect to it, and if I choose to use it directly, no one can stop me from using it. So this censorship resistance is something, of course, that we can't achieve in a centralized paradigm. But then the question becomes, for whom is censorship resistance so important that they're willing to trade off all of the advantages of centralized services? And my answer is there's effectively two categories of individuals and entities for whom that is a good trade. The first are people who are off the grid. In other words, they don't have access to the centralized services that we may take for granted here in an advanced economy and market system. So developing countries come to mind. The second are people who want to be off the grid, even though they do have access to centralized services. And this is where crypto assets kind of get a bad rap for being tools for gray or black market activity. No one, by the way, really knows the share between those two categories. And of course, I'm leaving out all the people who are trading and transacting these in a speculative and investment capacity and only focusing on what they're being actually used for. So lastly, on cryptocurrencies, I haven't really addressed I've addressed like what they're for and where their value comes from, but I haven't really spoken to where the price mania has come from. And I just want to briefly comment on why I think in the last year, cryptocurrencies have had this explosive speculative mania. I think you have to look at it from the perspective of the buyer and the seller mentality. And in essence, it is currently rational to be irrational as a buyer and a seller in this market. So on the buyer side, there are many, many people who invested early in Bitcoin, made tremendous amount of money, and now have effectively a house money effect weighing on them, where it's found money, it's a windfall, and they're diversifying into every new project that comes along because why not? And so if you've made money, you sort of say, I might as well keep going. If you haven't made money, and your friends have, or you've read about people who have, and you said no to Bitcoin because you didn't understand it, and then you said no to Ethereum because it was even more confusing, you didn't understand that, and those both went up by 50, 100, 1000x, depending on your time frame. Now you almost have this inverted mindset where you tell yourself, all right, I have to look for things I don't understand, and the more confusing it is, the better investment it probably is. And it's a very perverse mentality, obviously. On the seller side, that is teams and individuals who recognize the demand from buyers that now exists, it's extremely tempting to create an issue and sell a new cryptocurrency or token for three reasons. Number one, there's no dilution, it's not equity in the traditional sense. And there's no debt, you don't have to pay it back. People are buying for the appreciation expectations. It's really free financing, it's a remarkable instrument. And second, there's a belief out there that by selling tokens, you're creating evangelists for your project and that they will tell their friends. And the truth is that that's probably right. People are interested in spreading the news about a new token in order for their tokens to go up in price. And the sellers do have a kind of product market fit. Of course, the thing that people are buying is a dream of making money, not really interested in the underlying service usually. And then finally, there's an ability now, by issuing these tokens, to actually exit before you start. Normally when you build a company, the exit comes at the end, that's why it's called the exit. Here, if you issue a token and you can clear tens of millions of dollars before your project even launches, it's an even better deal than we had in the 90s. So, despite what probably sounds like a little bit of cynicism for me here on cryptocurrencies, and the fact that it's sort of obvious, I think, to every fair observer that we're witnessing a mania that will have a correction, at the same time, you should not bet against cryptocurrencies on their long-term sustainability or viability, and the reality that they are a new asset class, that they're enabling a fundamentally new and important segment, and I think will only increase globally in value over time. Finally, I wanted to just make a few comments on the second segment, the so-called private blockchains, which are different from these cryptocurrencies. And by the way, the noise and the hype are even greater, in my opinion, around these enterprise blockchain projects. Let me read you just 5 headlines that I pulled from the press recently. So from Forbes, blockchain, is it the missing link between genomics and privacy? The World Economic Forum asks, can blockchain solve the climate crisis? Huffington Post, do you want tamper-proof elections? Start with blockchains. The Wall Street Journal, will Bitcoin solve the migrant crisis? The World Food Program, blockchain against hunger, harnessing technology in support of Syrian refugees. And finally, my favorite from The Guardian, quote, blockchain, the answer to life, the universe, and everything? Question mark. The challenge, of course, is that the Bitcoin white paper, which was published at the nadir of the financial crisis, did not contain the word blockchain, so we have no definition to go from there. Trivia, the Bitcoin paper didn't even contain the word Bitcoin except for in the title. But in any event, we need a definition of a blockchain, and I'll provide one metaphor that I'll leave everyone with, which is to think of a blockchain simply as a storage and transfer mechanism for assets. And the best metaphor that predated this technology is actually a safe deposit box system at a bank, which is to say that there is some set of accounts secured in some environment, and yet the assets in each box are controlled by the owner of the assets through a key that they have custody over. So in one sense, you could say the money's at the bank. In the other sense, you could say, actually, I'm controlling the money because I have the key to the box. And that's exactly what a blockchain is, whether it's a Bitcoin blockchain that's public or a private blockchain. There's some notion of that ledger, and there's also a notion of keys that control the assets in them. Really, the only difference between a public blockchain that underpins the cryptocurrencies I was just talking about and a private blockchain that underpins the work that Nasdaq and the DTCC referenced is that in a private blockchain, the mechanism for ordering transactions happens in a centralized basis or on a consortium basis, as opposed to this sort of dynamic set of entities that are being rewarded by crypto assets like invisible hands on the internet. And as such, private blockchains do not have underlying cryptocurrencies. There are no assets like Bitcoin flowing through them. The assets on a private blockchain are existing financial instruments like securities, like proxy votes that we already are familiar with. And as such, these private blockchain technologies really are best thought of as new tools, a new tool for the financial industry to be more efficient and more secure. And lastly, I often get asked the question, well, aren't you just describing a database? If you don't have this decentralized ordering, there's no cryptocurrencies, it's just this sort of storage and transfer mechanism. And that's not a gotcha question. It's actually a good answer. Yeah, a private blockchain is a database for money. We have databases for lots of different lots of different types of data. They come in lots of different flavors depending on the goal. If the goal is to secure and transfer financial assets, having a database purpose-built for those types of instruments is quite powerful, and that's fundamentally what a blockchain is. So with that, I will end and thank you again for having me here and look forward to the questions from the committee.
First, I want to thank you all. This was a fascinating presentation, and it helped me understand a little bit more about blockchain and actually, you know, and especially Adam, I appreciate kind of putting it in very simple terms in terms of that, and then also, you know, the applications that you all are, the potential. So why don't I, before I turn over the committee, Ms. Stein, do you have any questions? So I think our minds are sort of close to exploding in terms of all the information, but I suspect some of the committee members do have some questions for you. So Stephen, and then Anne, and then Damon.
I second your thanks because this has been confusing to me and I'm a little less confused, okay? So I'd like to clarify one thing, and each of you have added a great dimension to this. My major focus is on trying to come up with a long-term benefit for a large percentage of the U.S. population. My personal major goal as being a committee member. And I am skeptical about cryptocurrency because I'm kind of a rational guy. And the notion of store of value doesn't apply to cryptocurrencies right now, at least, I don't think. So my question is this: am I correct that, let's say cryptocurrency comes and goes away, let's say rationality comes back or something like that. Nevertheless, am I correct that the DLT, the distributed ledger technology, could still have potentially great value for society? As you said, these are two really different things. I'd just like to make sure I got it right.
Sure. So cryptocurrencies will not go away, ever. There's an economic incentive for them to exist, and there's a big world out there and lots of different jurisdictions, so they'll exist somewhere. But to answer the question directly, yes, these two segments are different enough where one, they play off of one another and they reinforce one another at the level of the research and development. A lot of the same R&D bubbles up into both segments, but conceptually, one segment could exist and the other could fail. In terms of your opening statement, you sort of think about this in terms of mainstream impact. Let me provide just two scenarios where these technologies effectively go mainstream. The first, let's talk about the harder one to imagine, which is cryptocurrency. I think harder for most people to think about how could cryptocurrencies ever go mainstream. Well, the same question was asked of encrypted messaging. The only people who used encrypted email were hackers, spies, and paranoids. And then Edward Snowden, and then Donald Trump, and then a very different world emerged, where now Telegram, Signal, Secure Drop, end-to-end encrypted messaging within WhatsApp. Encrypted messaging is now mainstream. Your iMessages on your iPhone are encrypted. It is, whether you realize it or not, it has gone in the span of 5 years from a niche cyber hacker, phenomena to a mainstream reality. And so that vignette only serves to highlight one point, which is it's actually fairly easy to predict the evolution of a technology and how it will evolve and if it'll become more scalable and faster and smaller and all these things. It's much harder to predict how society will change to either embrace, reject that technology. In other words, the internet was actually fairly easy to predict once we saw the underlying innovations that made it possible, but Snapchat was very hard to predict. So we should never assume that because we see a technology, we understand how society will change and make it more relevant than it might have been in the past. And then on the distributed ledger side, the blockchain side, there was another analogy I used, which is for 10 years, there is this story about, will Linux ever appear on the desktop? Remember during the 1990s, Microsoft's dominance, there was this counterculture around Linux, and there was a lot of discussion about Linux appearing on the desktop and replacing Windows. And it sounds a lot like the conversations today. Oh, we're gonna have blockchains. Blockchains are gonna replace the, these market infrastructures and blockchain. And it was in the same way that Linux never really appeared on the desktop until it did. I think that blockchains won't really happen until they do. And what I mean by that is your iPhone, your Mac, your Android, it's all Linux. Steve Jobs, went to Next, created a Unix-based system, was acquired by Apple. Apple brought Unix under their operating system. That's Unix, Mac OS X. Android was a smart camera operating system that was acquired by Google and then was made the basis for their mobile phone, and that's Linux. So everyone is running Linux on the desktop now, everyone. And I think the same will be true on the DLT side, that it will just be the underlying framework. How exactly that happens, we have a specific point of view, and everyone has a different point of view, but it will just happen, and it won't be on the nose in the same way that Linux on the desktop wasn't on the nose, but it'll happen because it's a fundamentally better framework for building better products on top. And those products are what will drive the underlying infrastructure.
Let me ask one follow-up question.
Want to respond to that? You want to ask it now, or do you guys?
Well, let me ask you, because it might tie into a subsequent response from anybody. On the cryptocurrency, and I'm hung up on the notion of store of value. Is that just my problem, or will we'll come back to that notion? Tying in with store of value, as I read, Bitcoin, it's going to run out. Mathematically, there's a finite limit. Then supply and demand will go further crazy, I guess. How could that be a store of value if there's a finite limit of what miners can do?
Gold is a store of value because there's a finite limit.
Mm-hmm.
And the same is true of Bitcoin. The best way to think about Bitcoin is as digital gold. In fact, the predecessor to Bitcoin was called BitGold, which is a paper by Nick Szabo, and Bitcoin is a very slight evolution of BitGold. So, a store of value, there's really not, I don't think, great working definitions, but empirically, the market cap of Bitcoin was 0 in 2008, and then $10 million a few years later, and then $100 million a few years later, and approaching 100 billion. So certainly a store of value if you're willing to ride the ups and downs. But you're right that Bitcoin has a fixed limit of 21 million that will be issued. But that is part of the appeal for folks, that it's a sort of deflationary model where you know that there are only so many. They're divisible 100 million times, so there's no notion of like there won't be enough to go around. Nonetheless, the scarcity value is what drives the store of value and the perception and the belief system that supports the underlying technology.
Fredrik, did you want to comment on the previous, and then Jeff, I think, wanted to say something?
Yeah, I think it was more an addition to what Adam said, not a but a addition, and that is, a general public will never ever have to think about blockchain. They will either be exposed to a new kind of asset, and that asset will be valuable as long as there are at least two people that thinks that has value. It's not enough with one, but two. And that is, to Adam's point, quite likely to persist for a pretty long period of time at least. But the technology is a very foundational component in a technology stack. You won't ever have to think about your app, is that running on a traditional central database structure with a trusted third party, or is it that a distributed ledger technology sort of deep down in the stack? So people will experience it maybe through cheaper services, through new services, for example, new investment opportunities that we've already seen. So, and this will just be delivered, as we see now via the app. And that is really not that different from, you have your E-Trade app and you can see your stocks, or you have your Coinbase app and you can see your Bitcoins. So that was my addition to that.
Go ahead, Jeff.
Sure. So, yeah, thanks. This is a great question. Great insight. So you asked about sort of mass, broader implications, and it may be in financial services, or it may be outside of financial services. And I think that also these technologies can have a kind of an accelerator or convergence effect, whereas kind of blockchain is sort of developing in maturity alongside other technologies that are developing kind of safety and reliability in cloud and big data calculation, so computation. So I think that that they will enable kind of tools or functions that might not have been able before. And I spoke briefly about this earlier, but I think that things that sort of reverse the model around kind of investor or individual control of data. People are building, for example, browsers where you get paid to browse, and the more time you spend, you actually get compensated. That type of thing is only, will that work? I don't know. Seems like a pretty interesting idea instead of advertising and clicks, doing it. But I think that it's blockchain is an underpinning thing combined with other capabilities that may make some of these new models available. And as I said, that's being explored in kind of digital rights to intellectual property, health services, and elsewhere. I think that the second facet, and again I talked before about how regulators use technology. In fact, blockchain may change the way that the SEC, my former colleagues at the CFTC, and other regulators oversee markets and make them safer. So it may be sort of an indirect benefit, but broadly applied, because regulators can do their jobs more effectively because the blockchain and the real-time access to data and making sense of that helps them protect investors and protect markets. And I guess just to comment briefly on the stored value point, I think that, could Bitcoin go to 100,000? Could it go to 100? I think there's a lot of volatility. I think there's debatability. I think that is, one of the challenges to there being kind of futures product anytime soon, because of how do you build a risk and margin model around something that has that volatility and where, you really don't understand what the underlying dynamics that drive trading in it. So, I think you're right to be skeptical. Adam in the end may be correct, and we'll all be kicking ourselves that we didn't buy tons of it now while it was so cheap. But I think a lot of these things will ask.
I'm going to make it simple because I'm a simple guy. When blockchain started being discussed, it was a lot about clearing and settlement in the financial system and how blockchain was going to revolutionize it all. And the biggest clearer and settler in the world is DTCC, and we were going to disappear, which I took umbrage with myself. 4 years ago to retirement, but I still took umbrage. And that's why we kind of, did a lot of things to get ourselves back to the forefront and view it as a tool rather than a weapon that's going to be used against us. The man on the street's going to feel it through lower cost, very simply. It's going to take friction out of the system, because right now I am the central database for all securities, and then Morgan Stanley, Goldman Sachs reconcile with me, and then they reconcile their internal systems, and they send their statements out to their client, to you, and blah, blah, blah. Yeah, so, this is a whole massive reconciliation. Thank God I made a career out of reconciling. It's, something I'm very proud of. But that's where you're going to see it. You're going to take the cost and the friction out. You're going to speed up settlement. Eventually it will be gross settlement because we'll figure out how to deal with all of that. There won't be this massive reconciliation. Investors will know exactly where the securities are at any point in time. And not to bring up a touchy subject, but everybody in my company is very proud because of the Bernie Madoff stories, the DTC account, right? And that's the only time I think we've ever been used in a movie ever. But the whole point is what Jeff just said. The SEC would see exactly what Bernie Madoff would have. And instead of having whatever it ended up being, $28 billion, they would know that it was zero. And that's the other benefit, is that the oversight is going to be much more in-depth, much more real-time, and you can't hide behind a separate database because there is a database. And that's the power of that.
So I've got Anne, Damon, John, Barb, and then Rick.
Thanks very much. And particularly thank you for making this sound like fun. So, You know, Jeff says we need a sandbox for regulators. I don't know what the new Chair Clayton feels about this, but you know, a playground approach to all of this, marvellous. And also that Nasdaq works through a washing machine. This is terrific because I have a washing machine, so you know, it could all be easily understood. So I've got one comment and one question. My comment is about how much of what you're saying sounds as old as the hills. You know, the store of value, the collapse of value, this sounds like everything that was worried about with cowrie shells and later tulip mania, and it all hinges on the idea that a store of value exists so long as everyone believes in it. You can't eat Bitcoin. So it's a Tinkerbell. It's a Tinkerbell effect. You all know Peter Pan? Children, we must all believe in Tinkerbell because then she'll exist. But that's actually how markets work. So I don't think these are new features. The most important thing is being clear about the question about what is the purpose. And I don't think it's different. I don't view this as an asset class. You said, and I hope I wrote this down correctly, you said its purpose is to service and to reward the computers, which is sort of Isaac Asimov gone mad. Because actually, thinking about this from Kalper's point of view, all the purpose in the financial system is to serve the people whose savings are being put to work. We hope not to gambling and to speculation and losses, but to work. So if we don't keep that in mind, the investor protection is ultimately obviously the job of the SEC, and this committee is here to help with that. But making sure that ordinary working people's savings are being protected and deployed in ways that they understand. That's why financial services is called services. It's finance in service to the end user. I noted the chair. I appreciate the fact that he said Mr. and Ms. 401k. I thought that was rather good. So that's a comment about what's the same and what we need to keep in mind about purpose. The question I had was really this lovely phrase, I think, was it Jeff or was it Michael? Thelma and Louise. That's the other film you referenced. So the question here, we're thinking about fraud and ways that this system can improve investor protection, so that's good, terrific. But this idea of collapse, tulip mania, revisited in Bitcoin form. So when you talk about Thelma and Louise, what do you have in mind with Bitcoin? And what does that mean both for investors, but what more importantly for today, what does it mean for the role of the SEC?
Yeah, I was talking...
Although I think Thelma and Louise did the right thing.
Yeah, it was
When
good.
you look at the alternative, yeah, anyway.
I wasn't talking Bitcoin, I was talking distributed ledgers and smart contracts per se. So I do want to separate the platform technology from maybe an asset class, maybe not an asset class. All I'm saying is when you look at the way processing works today, through the role we play as well as the oversight by the SEC, the issuance of securities are very well regulated. Seeing there are practices, there are laws, there are rules of how, the disclosure, the transparency, the registration of the securities, et cetera, et cetera, et cetera. The processing, subsequently of mergers, acquisitions, the myriad numbers of corporate actions that can happen, they're all well defined and well understood and well seen because they're done through somebody like me. Now all of a sudden you do it on a distributed ledger and you have these things called smart contracts, and somebody writes the code that says on this day I will pay this dividend to somebody. That's the way it's supposed to work. Well, what happens when the coding error goes completely amok and says I will pay the dividend over and over and over again on the same day to this distributor, and also starts sucking currency out of the system and creating massive financial swings? Who pushes the button to say that's a bad code, turn it off? So I think it's this point about the private network. You know, at the end of the day, it's code. People write code, right? And people make mistakes. I'll introduce you to my tech people anytime. They're great, but people are people. So, I think this view that the whole security system has become completely decentralized, it would be simply a network with no oversight, has disappeared very quickly. That there is a role for somebody like ourselves to play. I won't be processing. The processing will happen on the network. But somebody has to control who gets on the node, You know, how do you permission the node? How do you send out information to the node? How do you allow contracts to be written? How do new securities, you know, how are they represented? What happens when something goes wrong? Who's got the authority to reverse it? So it's the combination of the SEC providing that general oversight, and then somebody's going to have to run the guts every single day of watching the code. I'm on the board of Digital Assets, which is a Bitcoin. It is a distributed ledger company. They're rewriting Australia's settlement system, and it's fantastic code. But you also realize the person who controls that code and controls the modification of that control manages the way the markets work. Very simply. So if nobody does it, if everybody does it, nobody does it. So I'm not sure if that's clear, but the thumb on Louise is just, you saw with Dow a couple of years ago, when something goes wrong, you can step in. Really goes wrong. Yeah, I mean, look, we talk about robotics, and it's very simple. I mean, bots are a simple processing tool to use. You know, they work 24/7 very fast. So when something happens wrong, it goes 24/7 very fast. And that's, you know, the biggest fear that, you know, these are all great technologies, but you can't be Pollyannish and think that I'll just throw it out there and it's going to work miraculously. Somebody changes a piece of code or a piece of information upstream, and all of a sudden things aren't quite the way they're supposed to be. So,
Jeff, did you want to?
Yeah, I can add something to that, and great question. And you know, you made the comment, you know, cowrie shells and tooling. Some of these things are not new, and you know, this is really you know, part of the importance of the steps the SEC has taken over the last few months with the report of investigation about the DAO tokens. But you know, what this work has made clear was that some of these, not the cryptocurrencies, but some of these token offerings are securities, and that, you know, there is already a framework for analyzing whether something is or is not a security. And if it is a security, then it needs to be offered with, and to go through a registration process, unless there's an exemption, offered to, and so on. And then there's also, you know, we have, I think, a very sensible framework. You know, the kind of riskier investments, if there's a lower level of disclosure, you know, those you might only offer to, you know, accredited investors, or sophisticated investors. Now, there's a lot of, you know, I think that, as I said before, I think that, you know, providing this clear dividing line, securities, not securities, and putting these things under this framework, I think was generally well received and was really respected. But, you know, there is still kind of debate. There are those who say, well, you know, everybody should be able to invest in these things. You know, why is it that only, you know, accredited investors can buy into the latest kind of token offer? So, you know, but there will always be people who complain that they don't have access to these extremely risky investments, right? Yeah, yeah. So I think it's important that there is a framework. You know, the framework is one that has worked. You know, I think it's important to continue to look at these things and see what's new. And some of these things are not securities and, you know, fall outside that category, and there are opportunities to invest. But I think that actually, you know, I give the existing framework actually a lot of credit for accomplishing.
Damon?
So, while I was sitting at this table, I got a text from a person I know who is reasonably well informed and is an investor in Bitcoin, to tell me that their Bitcoin has gone from $600 when they bought it in February to, I think, $5,000 today. Is that right? And as while I got this text, I was listening to our witnesses talk about a new economic model and free financing, and that people are investing, when they invest in cryptocurrencies, which is not necessarily a term I endorse, but which the panel used, the dream of making money, something that's miraculous. What have I missed? As somebody who's been around financial bubbles a bit, right? My alarmometer is at DEFCON 5. Yeah, me and Jamie agree on everything. I just keep remembering what Paul Volcker said about financial innovation in the aftermath of the last time that everything was different, which was in 2008. And he said the only valuable financial innovation since the Renaissance is the ATM. And let me go into a little more depth around this, and then I have a series of very specific questions for Nancy. What that means is that a ledger was invented in the Renaissance. A computerized ledger, that is, I think I saw one of those in 1987. So, on the one hand, the notion of blockchain as a distributed web-based ledger is at the same time, that's nice and probably valuable, but definitely not revolutionary in the sense that, or it's no more revolutionary than the ledger was when it was invented. What interests me in this conversation is not blockchain, it's Bitcoin. It's the things that are being moved. It's the financial assets that are being created, traded, speculated in here. And the question, I think, as Jeff said, the real core question, the Marbury versus Madison question, since we're at the Securities and Exchange Commission, is what is it? What is it? If it's an asset class, what kind of asset is it? Is it a security? If it's not a security, what is it? And my sense is that most of the conversation that goes on around this is essentially designed to obscure, and that uses big ideas and technical jargon to evade the fundamental questions that should be asked in this institution about any investment product. So let's start with this, Nancy. When I buy a Bitcoin, am I entering into a contract?
I am not a Bitcoin expert. Well, I guess it depends on how you think about the protocol. Because, I mean, when you're entering into a system, it's basically the protocol is kind of like rules of it. Like, if we wanted to analogize it to something that's existing.
Whoa, no, stop.
Okay.
No, you've now just done what I said I don't want to do, which is have a conversation about technology. I want a conversation about law. I give somebody some money. They give me some set of computer code back to my computer. Mm-hmm. What happens if that doesn't do what they claim it does? This is not a technical conversation. I'm not asking for your opinion about whether this is technically possible. Assume that whoever it was that wrote the code that creates blockchain created a poison pill in it. I don't get what I bought. My account doesn't come up. I lose my money.
Right.
Is there someone I can sue?
If you can find his identity.
Yeah, all right, okay.
Yes, you can sue him if you can find him.
And who's the him? And who's the him or her that I'm looking for?
Whoever wrote the code that you bought.
But we don't know who that is.
That is correct. Or.
Right. No, but let's, all right, now, hold it. Right. Now, so I've entered into a contract with someone who we don't know who it is.
That's right.
Okay.
You have chosen to do that.
Okay. Who's obligated in that contract? What I mean by that is, you guys have described a network in which there, in the case of, say, Bitcoin or some other cryptocurrency, there are all these people committed to a protocol, an algorithm, currency. There are all these people committed to a protocol, an algorithm, right? They're all committed.
Right.
It has rules which we've all promised to obey. There may be 100 million of us scattered around the world, and some of us may be drug lords and all that stuff, but we've all entered into this agreement. Right? That sounds like a contract, a big contract, with a lot of people. Is that right?
Well, I mean, it depends on offer, acceptance, etc., right? I mean, I haven't gone through the actual.
But let's presume there's offer and acceptance, all right?
Okay.
And you got all these people. Is that?
But then also, it also involves different contractual rules in different jurisdictions. Okay, forget about that.
Right.
So.
Right. But is it an investment contract? Is it an investment contract?
That depends on what an investment contract is. If somebody gives me the definition, I will evaluate it.
Here at the SEC, I think we have people who know the answer to that question.
Okay, great.
But if my point is that an investment contract, as discussed in the Marbury versus Madison of this field, the 21A letter, right, it sounds very broad. It's a contract in which people have rights to benefit from the entrepreneurial, managerial activities of others. it's very hard to not see that if you have this worldwide group of people engaging in all kinds of activity, but one of which is this thing called mining, right, in which people contribute computing power to this essentially cooperative or collective, right, that is the Bitcoin world, and which people are speculating on the value that's being generated by all this activity. That certainly sounds like an investment contract, doesn't it? I mean, and I'm not presuming that you know the answer to that, but I'm presuming that someone listening to this exchange does. It certainly sounds like an investment contract.
Can I weigh in here, Mr.
Yeah,
Silvers?
absolutely.
Since you
Yeah.
quoted me, I think it'd be only fair if I could.
Do you have any expertise on the question of what constitutes an investment contract?
Yeah. If you go,
what is
let me
your,
ask you,
what
let me
is
ask you
your
this.
expertise?
Let me ask you this.
What
If
is your
you-
expertise? Are you a securities lawyer?
Let me.
No, I don't want to hear. I don't want to hear marketing language. I want to hear law.
I won't give you
I want to
marketing
hear
language.
law. Are you a lawyer? Since you're not answering me, I don't think you are. I'm not
If you
interested. I'm
dig
not
up gold out of
interested.
the earth, did you have a contract with the earth?
Adam, can I suggest something to you? People who come talking about everything is now different, marketing investment contracts, tend to end up looking rather badly later.
If you dig up gold out of the earth, do you have a contract with the earth?
If you are engaged in a gold mining enterprise and you sell an interest in it to the public and you don't register it as a security, you've committed a crime.
Okay, here's the point of view I have. I won't use marketing language, I'll use a parable. If we,
Adam, you know,
Okay, there are other questions.
I'm deeply, deeply frustrated with a conversation that seems designed to evade the law in the context of what appears to be obviously a bubble.
I think it's a bubble too.
I understand that.
Yeah.
I understand you've said that, right? But I'm not interested in the slightest in parables or technical jargon. I'm interested in law. And you haven't said a single thing that is legally relevant.
Okay, thank you for that. John Coates?
Yes,
Next.
so, yeah,
And then Barb, and then Rick.
for the record, I happen to agree that Damon is right, that there are substantial legal issues about the way I understand Bitcoin, not only under the 33 Act, but under the 34 Act. And it may very well be an illegally unregistered company. I haven't thought through the legal analysis carefully, but if there's more than however many, 2,000, we have to accredited investors. Anyway, something to think through for the staff. I want to follow up on the specific statement that Adam made to see if Michael, Jeff, Fredrik agree that, maybe one real quick clarification from Adam. You said on all these dimensions, speed, cost, cryptocurrencies lose, except censorship resistance. Does that also apply to DLT more generally? Yes. Okay. Yes or no? Just real quick.
No.
No. Okay. Thanks. For the others, why is DLT attractive? Michael, let me just pick on you. Why are CDS through DLT technology at all potentially better? Because I got your point about the difficulty of aggregating and scaling. So why would you even think about it?
It is the concept of a single version of the truth that everybody sees and everybody shares and everybody updates. That's the nirvana you're trying to get to. It's a lousy database right now. And what we're seeing as we roll it out, or as we look at it, existing technology, as Adam says, usually works just fine. But there is this thought that we're working our way through, that if everybody shared one version of the truth, and everybody who could see it sees it, and you share that same version of the truth, it'll take a lot of friction out, it'll take fraud out, it'll just make the process work that much easier. You won't need a DTCC because it'll be done automatically through a network, but the benefit of that one version of the truth that can be overseen by the SEC, that's the golden chalice that we're all going for. Very simplistic. But right now, where it stands, it's got, as I said, sitting on digital assets, some incredible things that are happening. Some of the coding and whatnot is fantastic to see. But I'm not going to convert the U.S. financial markets do it in the next 5 years.
So,
Okay, I've got Barb and then Rick, and we've got only about 5-7 minutes because we've got a break we've got lunch and speakers also. Oh, go ahead, yes, sorry.
Just to follow up on what Mike just said, ultimately, this is just technology. It is there to support whatever you want it to support. And I think what blockchain offers is a better way of managing peer-to-peer structures. Many markets are today structured on a peer-to-peer basis. That is why we picked the private company space to do a pilot, because it is on a peer-to-peer basis. But the infrastructure is Excel sheets, guys on bikes, paper certificates, and bank vaults. Now, for the first time, we have a solid, modern technical infrastructure to be able to support that market structure. But ultimately, it is a decision about market structure, censorship, and those kind of questions. How do you want your market to work? Now we have an additional tool in the toolbox. It doesn't mean it's going to be used for anything and everything, but we have a new tool in the toolbox.
Jeff, quickly, and then...
Sure, quickly. So, Nancy showed us a telephone in her earlier slides, and so if those of us who can remember the game telephone, if I mention something to Michael, and he says something to Nancy, and the message keeps going down the line all the way till it reaches you, and then if we want to check, is the message that I gave to Michael, is it the same one by the time it gets to you? And at each level of this, if we have to check all of these, and then at some point Nancy's checking back with Michael and me to see if it's the same message, Stephen is checking with Adam. So there's a whole spaghetti web of different things checking with one another. It's very inefficient, but that's how our financial system works. There's a lot of reconciliation of different databases and messages. But if the message were just there in the middle where only people with permission could see it, that's the promise of the efficiency of this. There's a lot of work that needs to be done. There's things that need to get layered on top of it. But I think that's the promise of the efficiency, put very simply.
Can I say, well, we didn't talk about crypto security, where there are definite benefits right now, which quantum computing could blow away down the road, but there are security advantages, so there are other benefits beyond the single version of truth, and there's also a lot of risk. I didn't bring a paper today because we're issuing a paper next week on risk, but fragmentation risk, cyber risk that's introduced through FinTech, etc. We kind of gave you in 1 hour a very high level, and here's all the good things that could happen. There's a lot of risk that's also out there that we have to take into consideration.
We have another panel on all the bad things that can happen with something, right? That will be... Okay, so Barb and then Rick.
So I wanted to ask a question about the potential for the DLT for a regulatory purpose, and particularly one in this sort of concept of peer-to-peer. We talked about the accredited investor definition in this committee. And we have an approach right now that's based on financial thresholds, precisely because they're easy to verify, even though we know they don't work, to identify a population of investors who have the sophistication to protect themselves in the private markets. And when you talk about alternative approaches to that definition, so developing approaches that might serve that regulatory function better, they are inevitably more complex. And in a market where each issuer is responsible for verifying the accredited investor status, becomes hugely inefficient. And you have to have some kind of third-party verification if you want to have a definition that is more complex than what's your net worth and what's your income. And frankly, you could even use some third-party verification on those functions when you start tinkering with the definition of net worth. So the question is there a DLT solution to that kind of verification function that might allow us in accredited investor definition, in verifying whether crowdfunding investors are complying with the limits on their crowdfunding? Is there a regulatory tool in our toolbox that this provides in some of those areas?
Not yet, but they can be. It'll be it's a centralized database you would give access to that says, I'm trading with private investors on a peer-to-peer basis, I'm going through a brokerage firm or whatnot, and if you want to see whether or not I'm an accredited investor, you just have to go to this database, I give you permission, and you get the information. It could be done right now. We can centralize it, there's not an appetite for it, but it could be done right now. But it would be, again, one more database that everybody's got to reconcile to. You could do it on an automated basis or whatnot. But again, it's that single version of truth. As an analogy, one of the other businesses we run is the global trade repositories for over-the-counter bilateral transactions. We have an 80% market share. It would be perfect to build in a distributed ledger. Because right now, it is simply a reporting tool. Every regulator's top 20 markets have them, all written completely different because every regulator had a different view as to what they should get, but that's another story. But when you think about it, if all the OTC transactions that were done in 2006 and 2007 were in a single database that regulators could look at, they would have seen risk. And by the way, we had that database. The Trade Information Warehouse had 80% of all the credit default swap positions. And we used a tool we developed with Market. You could overlay it, and we showed regulators around the world. You saw the exposure of Japanese firms to U.S. firms. You saw the exposure of U.S. firms to French firms. And there was a company that started with the letter A with this massive exposure because the information was sitting in a database. Now, can you imagine if right now, Commissioner Stein could go in and say, well, let me see where there's exposure for, what happens if I run a simulation where the housing prices drop 20%? What happens then? All these stress testing that everybody does, you could just see it. And it would be the exact, nobody could come in and say, no, you're looking at the positions from my reporting system. Let me show you my market system. Or let me show you my credit. It's the same information. That's the real benefit for regulators. Regulators can look in and, again, see across markets. I mean, the SEC looks at cash markets. The CFTC looks at futures markets. CFTC and SEC will see some of the OTC markets, but not all of the OTC markets. What would happen if a regulator could actually work with firms and say, I'll see the entirety of your books across all your markets, and you can show me real time what your real exposure is. AIG, why are you, long the U.S. housing market so much? It allows you to question the questions to be asked.
Jeff, quickly.
Yeah, I echo very strongly everything Mike said, but that's really why I emphasized in my remarks, it's really important for regulators to start to get their hands on these tools and start working with them to test the data, to develop best practices, to learn to collaborate with industry and one another, and to really advance the ball in moving in these directions.
So, Rick, and then Mina, did you have a question? Okay, so Rick, go ahead.
I'll try to be very quick, and I think this is for you, Fredrik. I want to know sort of more specifically how would the securities markets change with DLT? So I bump into Commissioner Stein at a cocktail party 20 years from now. We're waxing nostalgic about the old days. It seems to me there's a few things that just go away. One potential thing would be street name. There's no need for street name if you know who all owns shares. So things like proxy overvoting would be a thing of the past. T+2, 2+3. Seems to me T+0 is where this would be headed. Failures to deliver on short sales. So my question is twofold. One, are any of those things wrong about what DLT might do for the markets? And two, what's not on my list?
Well, first of all, as I said before, this is just a tool. Actually, all of those questions are answered by the people that organize the market, not by the technology. But now you have a tool that can support some of those. So if you want to go, for example, T+0 is already supported today. Actually, many of the markets where we provide technology for in the Middle East already run T+0. That is not a technology choice. It's a market structure choice. And actually, they all want to go to T+2 because they want to be the same framework as DTCC for, So many of those questions, how do you want it to work? Do you want to have street name or no street name? Sort of, what are the rules for ultimate beneficiary owner? What are the opening hours? What is the settlement time? Maybe it's settlement optional. You can settle T+2 hours if the parties agree to that. All of that is market structure questions that the regulators and the parties in the market have to agree to. What we have now is a technology that can potentially solve it in a better way than traditional technology. So what is different? Well, that's designed by market design. What the technology hopefully can bring is to support that design cheaper, better, faster, with less errors, with more transparency for regulators than today's technology, or we see a combination. of different technologies. So it's a tool. It is not a market design.
We could go T1 right now, except stock loan and offshore trading. T1 in the U.S. markets, T0 in Japan. A little minor issue. I think T0 here was yesterday in Japan, so it's just like, how do you work the calendar? So, yeah, exactly. But Fredrik's absolutely right. It's market practice, market convention.
What about doing away with street name?
You can get, if you want to do that, that's fine. I mean, you could do that. I mean, it happens in other markets around the world where there's no concept of street name. It simply is in the owner's name. But that's not the convention. That's for efficiency purposes. That's not the way our market is developed. But it could go that way. There are issues there. But again, think about private data, et cetera, et cetera. But yeah, I mean, I agree completely with Fredrik. I mean, this just happens to be the construct we have. We try to keep on making it more and more efficient. And the new technology. We do T0 now, by the way. There's a misnomer that we have firms out there saying, I'm going to enable T0. We do it all the time. Firms do it. Morning trades, and we settle it in the afternoon. It's just not the market convention for the bulk of the transactions.
Just a quick, I know we don't have much time. First of all, thank you so much for taking the time to come inform us. You are on the front lines of innovation. As an investor, I think of the proliferation of assets that could be traded to advance investor portfolios and retirement securities. So I think that's an important consideration, something we want to look at. You also, I acknowledge that said, this is 1.0 and potentially 5 or 10 years in the making. So your points really lay out the importance of a regulatory and legal framework that we hope regulators and the public will come together to build out and address some of the concerns of interest here. Your views also help me ponder things like custodian issues. You talk about digital signatures as an asset manager who receive assets, who really holds the custodian of those assets. I don't know if we have time to answer that, but that's certainly something on my mind, because how do you think about managing portfolios in the world that we're talking about?
Want to say something now? Sure.
Just very brief answer. Rule of thumb, whoever has the private key is the custodian of the asset, just like the safe deposit box analogy. That box might have 2 keys, in which case there's shared custody. It could have 5 locks, and you need 3 of 5, and therefore the custody would be split over those 3. So when you think custody in a blockchain context, ask self, where are the keys that have to sign for the transfer of those assets? Think of the assets like bearer instruments sitting in boxes, and it'll help you get to it.
So I just wanted to say something that isn't a direct answer to your question, but I think various people have said, and I wanted to emphasize. For instance, I know that Damon was very concerned about Bitcoin, and we didn't want to go into the laws of other jurisdictions, very understandably. But the fact of the matter is those laws do matter, right? Because if you want to protect U.S. investors, U.S. investors have technological ways of investing outside of the U.S. They might not necessarily be in complete compliance with the securities laws while doing so. So, I mean, if you think about what Bitcoin might be under U.S. securities regulation, you also have to think about what it might be under, MiFID. What it might be, well, in China, it's not exactly popular right now. But, and you have to think about how to really effectuate law across jurisdictions, right? And I think that's the attractive notion of having a regulatory node sit on a network, because then you can see across portfolios and across jurisdictions.
Okay, I want to thank you all very much. This really was very helpful, and hopefully for the Commissioner also. So thank you for your time here today. The committee is going to recess into lunch, and we will be back at 1:30 here in this room to hear the law students.